This analysis comes from GlideLogic Corporation. It is not investment advice. The full document is Icahn Enterprises L.P. NASDAQ IEP's latest Form 8K, filed on May 16, 2025 at 5:30 p.m. Eastern Time. Let's dive in. With that baseline set, here's why this filing matters. Icahn Enterprises, ticker IEP, is a diversified holding partnership controlled by Carl Icahn. Businesses span investment, energy, automotive, real estate, food packaging, home fashion, and pharma. Today's 8K, items 7.01 and 9.01, simply posts a new investor deck, but the slides carry material capital structure details investors have been watching since the 2023 short seller fracas. With context covered, let's examine three standout numbers. $2.5 billion. Liquidity held through the investment funds as of March 31, 2025, item 7.01. $2 per unit annualized cash distribution, translating into a stunning 20.7% yield at the May 15th close of $9.67. $15.5 billion total consolidated assets at quarter end, down from $24.6 billion in 2012, but still sizable for a partnership with a $4.8 billion market cap. Now that the headline figures are on the table, let's zoom out to the bigger picture. Icahn Enterprises aggregates 7 operating segments. The investment arm remains the capital engine, while energy, majority stakes in CVR Energy and CVR Partners, supplies mid-continent refining and fertilizer cash flows. Automotive is restructuring after the Auto Plus bankruptcy, and real estate, food packaging, home fashion, plus pharma, Vivus, contribute niche earning streams. On the balance sheet, the partnership shows $15.5 billion in assets against $11.7 billion of liabilities, leaving roughly $3.8 billion of equity, though only $1.8 billion is attributable to common unit holders once non-controlling interests are stripped out. Net loss attributable to IEP for the LTM ended March 31st stood at minus $333 million. With the lay of the land mapped, let's drill into what this presentation really signals. Strategic context. Management repeats its activist toolkit narrative: buy undervalued assets, fix them, and cash out. Historical exits like the 2018 Federal Mogul and Tropicana sales remind listeners that IEP can crystallize value when markets cooperate. Liquidity of $2.5 billion gives Icahn flexibility to defend positions or pay distributions even during drawdowns. The deck calls attention to the $2 cash payout and hints it remains sustainable, but investors should note that coverage depends heavily on investment fund performance rather than operating EBITDA. No covenant breaches are reported, and the filing date, May 16, 2025, matches the event date, so there is no late filing S3 risk here. Next up, here's a rapid-fire checklist of downside flags. Distribution coverage relies on volatile hedge fund returns. A bad quarter could pressure cash flow. $6.8 billion of recourse and subsidiary debt leaves limited room for error in energy crack spreads or investment marks. Short seller litigation and pending regulatory inquiries continue to cloud sentiment. Automotive turnaround remains exposed to bankruptcy recoveries and parts inflation. To keep the story actionable, here are 5 follow-ups to put on your calendar. Q2 2025 earnings call date. Watch for updated fund returns. Any amendment to the $2 distribution at the next board meeting. Status report on debt refinancing plans before the 2027 note step-up. Closing timeline for any potential energy segment asset sale hinted in past calls. SEC comment letter resolution on non-GAAP disclosures flagged in March. Finally, let's wrap in 30 seconds. Icahn Enterprises' new deck mostly repackages known data, but the refreshed liquidity figure and reiterated payout confirm that Carl Icahn still has dry powder and confidence to fund that eye-catching 20% yield. For valuation hawks, the filing alone won't settle debates over net asset value versus cash burn, but it does reset the scoreboard ahead of summer earnings season. Disclaimer. This episode is provided for informational and educational purposes only and may contain errors. It is not an offer, solicitation, or recommendation to buy, sell, or hold any security, and it should not be relied upon as personalized investment, legal, tax, or accounting advice. Any forward-looking statements are made pursuant to the safe harbor provisions of the Private Securities Litigation Reform Act of 1995 and are subject to risks and uncertainties. Always review the issuer's complete SEC filing and consult qualified advisors before making investment decisions.